Hello, ladies and gentlemen. So, this starts the beginning of a section of the course that focuses on the political economy of globalization, or how politics and economics combine at the global level in managing the global economy. So, today's kind of introductory lecture is going to introduce three key concepts, the notions of comparative advantage, balance of payments, and exchange rates, which are all important for us to grasp in order to get at the more important materials that follow. And then we'll talk briefly about sort of big picture two waves of globalization over the last century and a half, and then ways to think about how the global economy is governed in the absence of a central authority at the international level. So let's begin with some key concepts, and we'll look first at the idea of comparative advantage. This is a concept that is important to understanding why it is advantageous for countries to engage in trade with one another. Um, the formal one way to define it is comparative advantage suggests that countries will engage in trade with one another, exporting the goods that they have a relative advantage in productivity. Um, Basically, the idea here is that um, countries, rather than trying to produce everything that they desire to consume, are better off instead producing only those goods where they are relatively most efficient at producing. Perhaps, Iowa is very efficient at producing corn, for instance. We have the soil, we have the terrain, we have the weather. Um, we also have the ability to borrow the capital needed to run huge, harvesters and combines. We have the rail networks to ship the corn to its intended destinations. So Iowa's, you know, has an enormous comparative advantage in producing corn. I was in southern Mexico some time ago and visited a farm where a gentleman was also raising corn, but it was on a very rocky hillside. He had no machinery at all at his disposal. He wasn't using, hybrid corns or cord seed or, Roundup Ready or whatever it's called, pesticides. He wasn't able to employ any of the advantages besides which the soil was thin and poor. So his yield on that corn would be very low. So uh, he had a comparative disadvantage in corn. So from a standpoint of Mexico, it makes a lot of sense to buy their corn from the United States, from produced in Iowa or elsewhere, Illinois, for instance, um, but then to pay for that with money that they earn from, for instance, the area that I visited was very well suited to producing coffee. Iowa was just not set up for coffee production. It's much too cold here. Um, we don't have mountains where coffee is often produced. So it's better for Mexico to focus on producing coffee, let Iowa produce corn, and once they trade, they'll both be better off. Um, so basically, comparative advantage shows that it makes sense to specialize in trade, but it also goes beyond just saying, well, if one country is better in one product and one is better in the other product. It even makes sense to trade if one country is the most efficient at producing both products over another country. Um, and in that case, actually, comparative advantage means that the country that is most efficient at producing both products should focus on producing its resources in producing the good that it is relatively most advantaged, where its advantage is the greatest. So, as an example, let's assume, and I think we don't have to make any heroic assumptions here. This is probably quite obvious that LeBron James, he can both play basketball better than me, and he can paint houses better than me. He's stronger. He can reach further. He's probably you know can last longer. So LeBron James probably can do both those things better than me. But he's probably only a bit better in house painting, but he's probably much better. Well, he is much better at basketball. Um, so basically, comparative advantage says LeBron should spend not half his time doing house painting and half the time doing basketball playing. Instead, he should focus all his time on basketball, and and um, and then I can go, I can give up basketball and go watch him play, right? Um, and on the other hand, I can do the house painting, and he can pay me to do that. So even though he's a better house painter and a better basketball player, comparative advantage says it makes sense for him to focus on where he has the greatest advantage, which is basketball, and hire me to do his house painting. So that's basically how it works among countries as well. And that means that if countries all follow their comparative advantage, then the global economy as a whole will be um, larger and produce more. Now, a second concept is balance of payments. Basically, this focuses on the financial accounting that follows from countries engaging in trade with one another, engaging in mutual investment, the tourism, um, even things like foreign aid, anything that involves moving money across national borders. When money leaves the country, it's counted as a debit in the national account. When it enters a country, it's counted as a positive in the national account or a credit. And so you basically, go through a process of toting up all of those debits and credits for the year, and you get at the end um, those debits and credits should basically even out. They should balance. That's called the balance of payments. Now, what's interesting about the balance of payments is not the overall balance, but it's the sub areas within it. So we can focus just on the balance of trade, which looks at trade in goods and services, or we could focus just on the movement of investment capital, right, which is bank loans or stock investments or bond investments. And then we could see, uh, how those things, um, whether countries are in balance or out of balance in particular areas. So the overall balance of payments sums to zero, but one of the consequences of that is that if a country runs a deficit in trade in goods and services, that means it's consuming more than it's producing. And in order to keep that up for any length of time, consuming more than they're producing, it's as if you were spending on your credit card. On your credit card, you're buying more than your income, going into debt. Then it means that in order to do that, you have to borrow money, right? So a country that is consuming more than it's producing, in order to make that work financially, they have to borrow money from the country that is a country that is producing more than it's consuming. So we don't have to look very far for an example. The United States consumes more than it produces, and China produces more than it consumes. So it means that the United States runs a big trade deficit. And how do we manage that? We borrow money from China to finance the purchase of those excess Chinese goods that we we consume over and above what we're selling to China. So in the long run, and accumulated international debts are reduced by cutting consumption or increasing production. A country can't forever keep borrowing money to finance excess consumption. Why? Because the countries they are borrowing from will eventually decide that the growing debt is means that the country consuming too much will not be able to pay back. So eventually their credit gets cut off. Just like if you keep consuming more than your income by building up credit card debt, eventually the credit card company will cut you off and demand repayment. So when that day happens, and it doesn't happen in one big bang, it happens gradually. The cost of borrowing money tends to go up over time for countries that are considered to have excess of debt. Well, when that happens, then a country has a couple of possibilities open to themselves to rebalance their trade. In other words, if you're consuming more than producing, you can fix that in two ways. You can either consume less to rebalance with your production, or you can produce more and sell more abroad, export more, and that will then lead your production to rise to meet your consumption. Generally, it's a both things tend to happen to some degree or another to bring a country back into trade balance. But when a country is going into debt by consuming more than it produces, it means that its people basically are subsidizing their current standard of living by borrowing against their future standard of living, so that the United States has been running large deficits in trade for many years, which means that basically we are borrowing in order to finance that trade against our future incomes. And at some point in the future, our incomes will have to fall in order to rebalance and to pay back the debts that we're accumulating. So, unfortunately, those debts are going to fall on you guys and your children at some point in the future. Exchange rates. So, we talked about money moving across borders, but of course, there's no global currency. Instead, each country issues its own currencies. And then we have to figure out, okay, if we're going to engage in trade, I have to accept your currency, you accept mine. We're going to need to figure out at what rate of exchange our currencies will be traded. And that basically, the price of a currency is set in the same way of a price of any other good. It's supply and demand. So how many, yen can a dollar buy? Well, it depends on the supply and demand of yen and dollars. If at a given point in time the supply of dollars goes up and the demand for dollars goes down, then the value of the dollar in yen will tend to fall. On the other hand, if the supply of dollars goes down and the demand goes up, then the value of the dollar will go up compared to the yen. So the value of a currency depends upon how much people want that currency and how much currency is available to trade. So currency trades are going on constantly. Some of them are because if you sell a good abroad, if American firm sells a good in Japan and consumers pay in yen, well, that American manufacturer doesn't pay their workers in yen, so has to trade that yen for dollars. So just to make trade work, countries are constantly changing dollars, but also to make investments happen across borders, and in fact um, to speculate on where you think the currency value is going to go. So if I think that the dollar is going to rise over the next week, then I buy a bunch of dollars now and I sell them after the dollar has risen in value. I make some money, right? So there are a variety of reasons why people trade currencies with one another, but those trades set the conditions uh, are based upon the supply and demand, which sets the price. So the exchange rate, that supply and demand is influenced by the policies of central banks, which issue or buy back their own currencies. It's influenced by trade balances, investment flows, etc. Now, one of the consequences of a currency, when a currency rises in value, if the dollar rises in value, it takes $1 will buy more yen today than it did yesterday. Well, if that's the case, then what happens is that the American exports become more expensive when they're sold abroad, and imports from other countries become cheaper when they're sold in the United States. Um, that will tend to, over time, discourage the purchase of American goods overseas because now they're more expensive, they're less competitive with goods from other countries. On the other hand, goods sold in the United States will be cheaper and therefore more competitive. Their sales volume in the U.S. will tend to rise at the expense of American produced goods or even goods from other countries. So the value of a currency affects trade. When the currency's value goes up, then a country tends to run their trade tends to move in the direction of a trade deficit. When the currency value goes down, then it tends to move in the direction of more exports, fewer imports, and thus moves in the direction of a trade surplus. Now, so those are some basic concepts. As you go through the readings, you'll see reference to comparative advantage, to balance of payments, to exchange rates. As you do, hopefully you now will have at least a basic understanding of what those terms mean. So let's look at two big questions with the time we have left today. And one question is, how globalized is our economy, is the world economy, and how has the degree of globalization, the degree of integration or interdependence among countries' economies, how has that changed over time? Well, this chart shows us a few key indicators. And what it amounts to is that there have been two big waves of globalization. Globalization in the early 19th century was very low, meaning that countries didn't trade very much with one another. There was very little movement of people or money across borders. Uh, Economies were basically local or national in scope. And so um, globalization was at a very low point. But as communication and transportation networks began to intensify in the 19th century, and as countries began to move to lower their tariffs or taxes on imported goods, um, those two movements together, lower tariffs on imports and cheaper communication and transportation, made it more profitable to trade among countries. And so trade grew, but also financial flows grew. That especially British capital began to invest in other parts of the world, um, building railways in Africa, or um, you know, financing industrialization in the United States, or um, other kinds of investment abroad. So we also began to see, again, with cheapening transportation, people moving from one country to another in search of a better life, in search of higher wages, more jobs, and economic opportunity. So in the late 19th, early 20th century, up until 1914, you can see the red line here is investment, money moving across borders. The kind of orange line or yellow line is uh, growth in the movement of labor or people across borders. There was some growth, you'll notice as well, in the blue line in trade, although that was less dramatic than the other two indicators of globalization. But look what happens with the 1914, um, the 1914 through about 1950, investment across borders just really cratered. Um, Capital, became much more national, and the movement of peoples across borders also declined. Trade declined as well, although less dramatically because it didn't reach quite as high a peak as the other two. So what happened basically is you had two world wars and the Great Depression, all of which, meant that tariffs were raised higher, transport was disrupted, um, governments, um, the gold standard that had allowed for international monetary system to facilitate investment, that really fell apart. So all the basic foundations that had allowed globalization to rise in the early 20th century were just torn apart by two wars and the Great Depression. After World War II, the United States began to rebuild the basis for a global international economy. And you see here the fruits of that investment in the red line begins a dramatic increase. The blue line, the trade reaches levels never before seen by the recent years, basically. And then you can see the movement of people having basically immigration had reached a low point in the 1950s and began gradually increasing um, uh, in the 1970s, and then even more rapidly in recent decades. So you can see, if we look at the two waves of globalization, we'll see that the wave one peaks, exports were lower at about 8% of the global economy than in 2008, the wave two peak, which reached almost 20%. On the other hand, foreign capital stock, the movement of investment across borders, was actually higher in 1914 than it was in a century later. And the movement of migrant stock was higher more in 2015 than 1914, but not that much higher. It was comparable to 2.5% to 3.3%. Um, so globalization was very high at the beginning of the 20th century. It was high at the beginning of the 21st century, but there was a kind of a trough in mid 20th century. One thing that tells us is that globalization is very sensitive to political disruption, especially war and especially economic downturns tend to erode support for globalization and disrupt the linkages that make for globalization. So let's look at what are some of the major factors. If we know globalization is not irreversible, we've seen it reverse in the past. What are some of the factors that can disrupt globalization? Well, one is that you need a major power that is liberal, or we call it major power being a hegemon is a dominant country, a country that has more power than any other country. And the two hegemons that who oversaw globalization in the first wave and the second wave were Great Britain in the first case. Great Britain was an enormous financial power. It was a great trading state. It had a navy that the Royal Navy protected the freedom of navigation, and it had an enormous, earth-spanning empire. So Great Britain served as kind of the anchor of liberalization, of globalization in the late 19th, early 20th century. And the United States did the same after World War II. So having a dominant country, but a dominant country that is free market oriented, that has a capitalist economy, that favors globalization and openness of the world economy. If Nazi Germany had won World War II, we would not have seen a second wave of globalization necessarily. Or if the Soviet Union had won the Cold War and the U.S. had disintegrated. So it doesn't just take a powerful state, it takes a particular kind of powerful state. And when British power declined in the early 20th century after 1914, its ability to sustain globalization also declined. As the United States power declines in recent decades, its ability, but also its willingness to facilitate, to protect globalization has also declined. International economic institutions, one of the differences between the two periods is that there were fewer international organizations or institutions under British globalization. Under U.S. globalization, there were stronger institutions. I'm talking about things like the World Trade Organization, the International Monetary Fund, the World Bank, the European Union. There were strong global multilateral institutions that set the rules of the international economic order and promoted globalization actively. And those institutions certainly help prop up globalization. But when they weaken, then globalization can also weaken. And some argue that what leads institutions to weaken is when their primary sponsor, a liberal hegemon, declines, then the institutions tend to weaken. A third factor is financial crises. When there are financial crises, which basically the Great Depression was a financial crisis, then countries begin worrying more about protecting domestic employment than they do about protecting free trade. And so often they put up trade barriers. They call home capital that had been invested abroad as a way to try to protect their political position at home. And that can disrupt globalization. So we saw the Great Depression was a financial crisis of sorts. And more recently, the 2008 financial crisis just led to a disruption of globalization. Great power war, obviously, World Wars I and II were, deadly for a global economy. It's countries that had traded greatly with one another, like Britain and Germany before World War One, cut those ties and basically tried to starve the other country of needed imports. And then finally, the rise of nationalist and protectionist political forces. So if there's no political consensus in favor of freer trade or globalization, if people are demanding, tariffs to protect their home manufacturers, if they're protesting against immigration flows, or they turn against globalization of capital, then globalization will wither. So these are the five basic factors that can disrupt globalization. Now, what's worrying is that several of these we see in the present period. So, the United States remains a very powerful country, but it's weaker certainly than it was in, let's say, the 1990s. But it's also less willing to defend globalization. We've become more protectionist because of factor five, the rise of nationalist and protectionist forces in American politics. So the combination of that, we're weaker and we're more protectionist, mean that many of the institutions are no longer have the support they once had from the most powerful country in the world. And we do have continue to have international economic institutions, but as I said, there have been signs of weakening. The last attempt to try to create the World Trade Organization has grown through a series of negotiating rounds, and the last round basically fizzled out with a very weak agreement that fell way short of expectations. So, in the ability of the WTO to preserve a free trade order has certainly declined. We mentioned the 2008 financial crisis that did set back, especially investment flows across countries. And now with the pandemic, we're once again seeing a disruption to exports and financial flows and immigration. People can't even travel across borders in many cases. And then great power war. Luckily, we haven't seen a great power war yet, but what we are seeing is the emergence of great power rivalry between the United States and China that has led many Americans to call for decoupling the economic ties between the U.S. and China. So, in some degree, we're seeing all five of these factors reemerge, which leads some to worry that we may have another period of deglobalization, which could hurt economies around the world. Now, the final thing I want to touch on today is the question of how the global economy is governed. Any global economy needs some kind of rules, but the question is, what kinds of rules? How strong should they be? How much autonomy should national governments have to set their own distinctive economic policies and strategies? How much should democratic politics play? Role should democratic politics play in managing the global economy? So let's look at this interesting diagram based upon the work of a Harvard economist, Danny Roderick. It's called the Political Trilemma. And basically, Roderick says that there are three things that are desirable. One is to have deep economic integration so that countries really do fully take advantage of the idea of comparative advantage, and that leads to maximum efficiency and raises incomes around the world. A second is that we'd like to have, democratic control over economic decision making and policy making. And the third is that countries desire some degree, national sovereignty. They want their country to be independent and autonomous in significant degree. The problem is that even though all three independently are desirable, Roderick argues that you cannot have all three, that there is a trilemma such that it's possible to have two of these, but in doing so, you have to give up the third. And so if that's true, then there are three combinations that are possible. One combination he calls the global straitjacket. We could think of this also as market-led globalization. And this combines hyperglobalization, which is deep integration, deep high levels of trade and investment and uh, movement of labor across borders. So hyperglobalization, um, that can be combined with national sovereignty, where you have countries are remain independent countries. Um, However, they basically open their economies, which limits the ability of their people through democratic policies to um, make choices about what kind of economy they want to have. So, for instance, if an economy is fully open, then it's impossible for the central bank to control its monetary supply so as to um, force down unemployment, for instance. Basically, many people have argued that you can't run a social welfare state if your economy is fully open to globalization. Um, so basically, uh, a fully globalized economy is not subject to democratic control. So that's one. He calls it the golden straitjacket because you kind of tie your hands with respect to economic policy making, but you do so in hopes that it'll lead to higher rates of economic growth. A second is that um, you combine national sovereignty with democratic policies. Here he calls it the Bretton Woods Compromise. The Bretton Woods was the agreement reached after World War II, creating the IMF, World Bank, the what was then called the General Agreement on Trade and Tariffs. Basically, the global order at that time. He says that the Bretton Woods system allowed for a limited globalization, but retained significant degree of national control over economies and allowed some countries became social welfare states, other countries became free markets, other countries focused on heavy industrialization like Japan. And so the one way of looking at it is that the U.S. protected consumers, Europe protected workers, and Japan protected producers. Um, so there you retain the ability to make choices, um, and you continue to have significant controls over global flows of trade and money and peoples, even as you allowed them to gradually, incrementally increase. Um, but it was what he called thin globalization rather than hyper globalization. The advantage here is that countries get to make the choices that best meet the demands of their own populace through democratic politics. Now, the third option is to say, well, um, what if we combined? We want hyperglobalization. We want to have free markets, but we also want to have some democratic input. What we could do is create global institutions that um, that raise that through democratic demands raise the level of standards for the global economy. For instance, worker standards or welfare programs would be protected not at the national level but at the global level. So, for instance, you might have global agreements that prevent countries from exporting goods made with slave labor or sweatshop labor. You might have global agreements that set high levels of environmental standards so that countries can't undercut one another by um, businesses seeking out the country with the lowest environmental standards. You could try to have level out taxes so that businesses won't seek out pit countries against one another in a race to lower taxes to attract capital because they'll face the same tax treatment everywhere. So there you allow for a higher degree of control over capital, but not at the national level, but at the higher level, at the international level. We can see here the market-led globalization combines hyper-globalization and national sovereignty. That corresponds basically to pre-World War I period under the British, and also to the period since 1980 when we sort of left the period of Bretton Woods system and moved into an era that focused on free markets up until about 2008 when the financial crisis disrupted that model. The state-led, where governments, had meaningful choices. That was the Bretton Woods system that basically lasted from 1944 to 1979. And then you have the institution-led. We've never had this at the global level. Institution combines democracy and hyperglobalization, but you do have it at the regional level within the European Union, which basically was created in 1993 and up to the present. So, three kinds of ways of managing the rules of globalization. One that gives control over to markets and capital, another that vests control in the hands of national governments, and the third which puts control in the hands of global institutions. Well, that gives you, it's kind of an introduction to our discussion of the political economy of globalization. Thanks for your attention.